If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
What's going on, everyone? I'm Shawn Winslow, and this is the Multifamily Money Podcast. Welcome back to another Multifamily Monday episode where we're talking all things multifamily apartment investing. And today I just want to go over kind of like a state of the market update. Recently, both Yardi and Marcus and Millichap came out with their 2022 outlook, and I've had time to sit down and go over both of those, and I just want to share kind of my thoughts on those. Obviously, if you want to check out those, you can find them both on their website. You simply just have to put in, your information, your name and email, and you'll be able to download it. But I just want to go over some things that I looked at that I thought were, important to us as investors and kind of where they feel the market's going and whether I, agree with them or not. Before I jump into that, last episode, I did mention that I had a goal to get to 100 ratings and reviews by the end of the year, and that we're already at 50 just a month in. Big jump. So that I kind of decided to change that goal to halfway through the year. So in June, I want to get to 100. And since that episode, people have, left some reviews. So I just want to give a shout out because I really appreciate that. So this one's from John.Lipsky1699. He titles it, "He's the Man." Oh, I appreciate that. And he says, "Shawn Winslow is the one guy in real estate that I truly admire. He is extremely knowledgeable about the system of real estate investment, and he has taken my ambition to achieve financial independence to a whole new level. This podcast is a great compliment to what I just mentioned, and I highly recommend checking out all of his work." Well, John, I really appreciate that. You're too kind with those words, but thank you so much. And again, everybody, if you haven't done so, please leave a rating review. I'd greatly appreciate that. It's one of the top things in Apple's algorithm that, gets the show out in front of more people. And also, if you find any value from this and anyone that could also find value, please share that with them. All right. So let's jump into it. We all know that 2021 was a banner year for apartments. We saw rents, on average, just go through the roof. We saw, places that had 17%, 20%. Even I think there were some that, flirted near that 30% growth rate, which is just crazy. Now it's going to be a little subdued this year. Obviously, it's going to retreat a little bit, but most outlets are predicting that it's still going to be above, the average rent growth. And I agree with that. It's definitely going to be above, your average 2 to 3%. I'd say it's going to be anywhere from the 4 to 6% range on average. Obviously it all depends per asset class and per metro. A lot of this stuff we're going to go over today, really depends where you're at, in the country. Things differ. And as an investor, I'm sure you all know, that you can't just take everything as a whole. You really need to dig deep into the markets you're investing in, because not every market will behave the same. And also there's underlying economic trends, fundamentals that will change throughout the year from one market to another. So, all right. Kind of the top markets for the year, a lot of them were in the Sun Belt. I'm pretty sure most people would have guessed that. A lot of people moving, from the Northeast down to some of the southern states like Florida, Georgia, Carolinas, to escape the kind of dense populated areas of the Northeast, but also kind of to seek out some of the warmer weather as well and more space. But so the top three are Orlando, Las Vegas, Fort Lauderdale. And then to round out, you got West Palm Beach, Phoenix, Salt Lake, Austin, Tampa/St. Pete, Atlanta, and rounding out the top 10 is Miami. So a lot of those are in the Florida metro. It's kind of understandable the way that they've handled their policy when it comes to the world health crisis and also the warm weather and, a lot of outdoor space. And that's what people are looking for. So that's kind of one of the big themes. And I think that as an investor going forward with the whole new shift in how people live and work, one of the big things that you should be looking for in a property is larger unit sizes, so larger square foot per unit. That's very important to people because now that they're not only living there but working from there, you want more space. You don't want to feel so confined. Coming from before, pre-pandemic, when you're only there really to, come home after work, eat, hang out, sleep. You didn't really feel like you needed as much space, right? Because a lot of your time was spent at work. But now that, almost all your time is spent at home, you don't want to feel so confined. You want more space. So I think that's a big thing to look for when looking to invest in a stabilized property. And it'll be interesting to see what developers are doing on that front going forward. Because I know in the past it's been not to do that because you want to get as many units into, a development as possible, better returns, right? But it'll be interesting to see if they kind of tune that back a little bit and start to build a little larger units. So yeah, again, the Sunbelt metros are, commanding top positions, and the way they rank this, there's a lot of factors. There's obviously, your rent growth. Then they look at, occupancy, high occupancy, low vacancy, job growth, income growth, and also, price per door. They look at a lot of these major factors to come up with this list. Net migration. And then, so at the beginning of the health crisis, we saw, people leaving urban areas to go to suburban. And now we're kind of seeing the urban start to fill back up again. Not that people aren't necessarily leaving the suburban areas at the same rate as we saw them leave the urban areas, but we're seeing some of these urban areas, command some higher rents again, occupancies going way up. So that this is good for the market. And I think it'll help kind of level out some prices eventually. But the thing we want to talk about is like job creation, where the job market is, because obviously, as we've seen these huge increases in rent, we have a huge issue already in this country with affordability, with affordable housing. So as rent skyrockets, people are not working. Are they actually going to be able to afford these rents, or are these rents going to eventually just crater? And so what we're kind of, seeing is people obviously left work. They either, furloughed, laid off, or just decided to not work anymore. And that was a multitude of factors. You had people retire early just because why not, right? Why go through this crazy work environment, for a few more years and then retire, just retire early. You had people staying home to take care of children because the children weren't going to school, and it was cheaper to just, quit your job and take care of them than have to find and pay for, full-time childcare. So you had that. And then you had people that were just, with the stimulus that was flooded into the economy, people that were not being paid, adequately, they just left. And, this has kind of been supporting these people for a while. But as we see, the stimulus cease as it has, and, there's still some rent assistance programs. And as we see those to cease, kind of pull back, and combined with inflation and the cost of living going up, I just have a strong feeling that we're going to see people come back to work. And a great thing about it is since people have not been working and it's been hard to hire, wages have gone up. When we've seen wage growth at on average 4.8%, and we haven't seen that in decades. So that's very good for the market and very good for those being able to afford these higher rents. And what I see is also happening is employers are having to find out how to operate, with lower staff number than they're used to. So they've, had to, be flexible, ingenuitive, and find new ways to operate, which then in turn, when people start coming back to the market, it's going to make it competitive, right? And people are going to come back and get higher paying jobs, and it's going to support this being able to afford these higher rents. And like for instance, Marcus and Millichap, I'll just read this for you. They say labor market to find a new equilibrium this year. After the unprecedented loss of 22.4 million jobs in spring 2020, and the equally unprecedented recovery of about 20 million of these positions over the subsequent 20 months, employers entered 2022 facing a shortage of qualified candidates. Participation in the labor pool dropped at the onset of the health crisis as some individuals retired early or stayed home to take care of children. While health concerns are abating and students are largely back in classrooms, labor participation may take time to fully recover. Some households have transitioned to one income while employee expectations of workforce flexibility are higher. Companies pressing for a complete return to offices may face some staff shakeup this year. Competition for talent will continue to lift wages after the average pay accelerated by roughly 5% in 2021. Higher earnings should prompt more people to join the workforce, while at the same time, rising employee costs require firms to streamline operations. These two forces will drive the labor market to a new equilibrium between business needs and available human capital this year, from which future organic employment growth can occur. So that's simply what I was just stating, is that it's going to be really competitive still to hire people because not as many people are coming back, which it's going to increase over time. Give it a year or two. But this is also going to drive that wage growth, which is very important to sustain this rent growth, because a lot of these outlets are still predicting, 5+%, rent growth, which is, above average. And so now the question is, but is this still like a solid investment, right? And I've stated this before, there's still a 4 million household deficit, right? So there's still 4 million units that we need to produce, and a record 1.6 million households will be formed in 2022. So it's only increasing this $4 million number. Yes, the market absorbed 400,000 units last year and is predicted to do the same this year. About 380,000 to 400,000 is the estimate of new apartment units coming to the market that construction will be completed. And the outlook is that they will be fully absorbed just due to the demand that is out there, which is crazy. And I agree with that, because what we've seen that we're able to the rent growth from renewals we're able to get and how competitive it is out there, and just continues to be competitive. These new units, it's still not enough. 400,000 to a 4 million unit deficit with 1.6 million families being formed. And this will continue because a lot of this is driven from the millennials, because currently the millennials are the largest generation. And this is where kind of like in the middle area of the generation where people are really starting to form families. So this is going to continue increase, I would say, for the next, 5 to 10 years, if not more. This will continue to boost supply growth year over year. And we've seen a compression in occupancy between, the A and kind of C class properties, which generally there's like 100 basis point or more, so 1% or more difference in that occupancy, and it's compressed down to about 10 basis points, so 0.1%. And so when you're looking at that, you're looking at like the lifestyle living, the class A, and then kind of like the rent by necessity, the class B and C, which is what we focus on, which it is healthy for the market, right? And majority of those 400,000 units, a lot of them are kind of the lifestyle type of renting. And when you say lifestyle, you mean it's like your choice to rent, right? You could either rent, or you could go buy something. It's your choice. Whereas rent by necessities, you kind of have no choice. Renting is your option. And to go off of that, another thing is why I love this asset class so much is, looking out into the future, is because what we've also seen in the market, we all know, is in the residential market, is prices have just gone through the roof. Yes, interest rates are low. So, actually your monthly payment of your mortgage is probably around what it was, if not lower, 3 years ago. So from that point, it makes complete sense. But from a down payment perspective, your mortgage payment might be less, but when you're paying 10 to 20% down payment, on $400,000 house versus maybe it was like 300, 250 before, that's a big difference. And that's going to price a lot of people out, just that, down payment and closing costs. So this is also fueling the demand for multifamily apartments solely based on that fact. And also rents too. If we look at, rents compared to mortgages, and overall, it is still below. So rents are still tracking below average mortgage payment, meaning it still is more affordable on average to rent than it is to own. Now, obviously, like I said, a lot of this stuff you have to, take with a grain of salt when it comes to your market or another. So obviously don't say like, Shawn, that's not the case in my market. Well, yeah, it probably isn't. You're right. But this is on average. So again, it all comes down to your market, and you have to, take what I'm saying with a grain of salt when it comes to that. All right. So next, I kind of want to just hit on kind of the overall national outlook, and kind of not only demand from renters, but what's the demand, like important aspect of it is like from a financing perspective, right? Like, yeah, cool. There is demand for renters, but is there still like demand for those to lend? And that's a big yes. And that's still led by agencies. So I know for a while there, people were, concerned like, oh, it's mostly just bridge lenders out there. Fannie and Freddie are kind of getting off the gas a little bit, making it a little harder. Which then if you look back at the case, that's not the case at all, because they did 130 billion in transactions last year. And the federal government increased each of their budgets for this year by 8 billion each. So now you're looking at, 140 billion that they're allocated to, they're budgeted. Actually, excuse me, I take that back. It's closer to 160 billion total. So 78 billion a piece they're budgeted to fund, these multifamily apartment deals. That's a lot of money to go after transactions. So, if you do a little quick math there, if you were to say an average of 20% down, you're talking, talking about 1,256 times 5. So you're talking about, 780 billion, $780 billion in total acquisition costs. So total purchase price. That's a lot of deals, right? That's a lot of, so they clearly are still in the game. They know that there's a lot of demand for a living of all types, from affordable to lifestyle, and they're going to be funding it. And from what I've seen, the bridge lenders still have a huge appetite. There's even some, they're called collateralized loan obligations, CLOs. There's a lot of appetite from them out there. They're more of that's like a floating rate. So, you're fixed for a period of time and then it floats. So then your interest rate will jump. And why people are doing this in this market is because the rate is still so low that they're not fearful that it's, even with the Fed saying they're going to raise rates, that it's going to raise to a point where it's going to blow up their deal. Now, personally, that's not something I want to get into. I'm a little more risk averse when it comes to that, just because, it's what we saw obviously in 08, all these floaters just all kicked in at once and people couldn't afford it. They were, underwater on these things. So personally, that's not something I recommend, but to each his their own, right? So there still is demand from the funding perspective, and we all know there's demand on the equity side. People want to invest in this asset class, and who could blame them? I'm with them. The demand is crazy. There's rent growth is still going to be above average. So this is something that I'm very excited this year. And then when it comes to like interest rates, obviously that's a huge part. So we know the lenders have demand, but or have an appetite, but what's going to happen with interest rates? And that's obviously the big question. I don't have a crystal ball. However, based on what's happened recently, and by recently I mean over the last decade, anytime we've seen the Fed taper and then raise rates, for instance, I'm thinking 18, they did it twice, and then the market crashed, and then they peeled back on that, right? And they lowered rates. They started buying securities, buying bonds, and then it corrected the market. So I really don't, they say they're going to raise 3 times. I say they'll raise maybe twice to a total about 50 basis points, so 0.5%. And then I think if the market does not act appropriately in their eyes, they will then cut back on that. They can't afford the market to crash right now with everything that's going on, from the health crisis to supply chain issues, affordability, inflation. They just can't afford the market to then, tank. And I just don't think they really have it all in check. I don't see inflation dying down anytime soon. Yes, I think it's gonna kind of apex, but I don't think it's gonna all of a sudden come back. Prices are just not gonna retreat overnight. The supply chain issue, I think it's getting a little better, but it's still nowhere near where it needs to be. And it doesn't seem like the government says that they're trying to fix this, but I don't really see anything major happening that's going to again change that overnight. I still think there's going to be supply chain issues and inflation throughout 2022, and we'll get a better sense probably halfway through the year, 3/4 of the way through the year, what 2023 will look like in regards to the supply chain and then thereby inflation. So I don't see that correcting. And in terms of long-term rates, I just don't really see where rates could really go far above 5%, if really at all. Because we all know in the last, 18 or almost 24 months now, right? Within the last 18 to 24 months, 40% of all money supply in the United States history was printed. That's insane, right? And that's just adding on to our deficit, right? So there's no way that we could afford to pay, all that back, that type of interest rate on that type of debt, by going up above, 5%. Everyone always says, yeah, but we're the United States, it doesn't matter if we don't pay. Well, it could if some of our biggest creditors, biggest lenders are, some major countries. We don't have issues with them, and they obviously would want to get paid. So that's not something we want to, flirt with. So I just don't see where interest rates could really go above that 5%. And that's why we haven't seen like Greenspan did back in, was that the early 80s or late 70s, where we were in a similar inflationary period where he jacked rates up to 18%. And that's what, kind of squashed and calmed down that inflation. But we couldn't do that, not because there was, I think at the time, there was relatively no deficit then, in terms of what the country owed. So that was, a scenario where they could do that. That's a tool they could use. That's not a tool we can use in today's world with the amount of debt this country has. So from that perspective, I still think it's going to be great from a lending perspective. Now when it comes to underwriting, you still want to be conservative on your kind of your exit caps. Like don't, if you're buying in at a 6 cap, don't underwrite that you're going to exit at a 5.5 or 5 cap in 5 years. That's just not smart. I would say usually people say to underwrite 5 to 10 basis points per year above your entry cap. So if you're going to do 10 basis points per year for 5 years, that's 50 bips. So if you went in at a 6 cap, you'd want to exit at a 6.5 cap. That's just a way to be really conservative, especially in a time where the Fed says they're going to raise rates. That's how you should be exiting. Now, every deal is different, but that's what I'm comfortable doing. I think that's what most people should do. A prudent investor should do, especially in this time where we're going to see rates rise. I know, like I said, it's not going to be a lot, but it's safer to do that. In terms of the markets to be in, we're going to see, obviously the Sun Belt is still going to be strong. People are still moving there. Companies, job growth is really strong there. Those are still the markets I'm going to be focusing on. Now, in terms of where the building is coming, the development is coming, there's going to be a lot in the Dallas-Fort Worth area. I think there's going to be about 20,000 units there alone. Austin's going to have a lot of development. Raleigh, North Carolina is going to have a lot of development per Yardi and Marcus and Millichap. So those are things you really want to look at, see like what that net absorption is going to do to your overall, occupancy, vacancy, and where you're going to be able to, get rents at due to that, either demand or lack of demand because of oversupply. But as a whole, I don't think there's really going to be much oversupply anywhere, just because a lot of those places I named, a lot of people are moving there and there's huge demand. And obviously with a 4 million unit household deficit across the country, with another 1.6 million in households forming this year, there's still going to be massive demand. So I love this space. I think this is a great space to be in 2022, 2023. There's still great investments out there. I wouldn't want to be anywhere else. And also, as I've always said, it's a great inflation hedge. And in Marcus and Millichap's 2022 outlook, that's one of their points, is that it's an inflation. Inflation concerns favor apartment assets. In addition to the many other favorable factors driving multifamily investor demand, inflation worries are highlighting the property type's potential as an inflation hedge. Appreciating property values and the ability to adjust rents position apartments as a favorable option in a higher inflation climate, dynamic likely to drive new buyer demand this year. It's like I mentioned one of my previous episodes, Tiger 21, they put together their group for those that don't know, they're a group for like ultra wealthy people. You have to have like a net worth, like investable assets of 10 million or more to even be qualified to get in there. And that was one of their major investment outlooks, was buy apartments for inflation protection. Their whole investment thesis was inflation protection, and one of their top investments was apartments. And I continue to hit on this. This is one of the best asset classes for that. So yeah, I don't want to bore you all too much. I would definitely go check those out, both the Marcus and Millichap outlook and the Yardi outlook. The Yardi's a little lighter read. The Marcus Millichap one goes into a little more depth, and there's a lot of good stuff that I'm not even talking about, but I just want to kind of highlight on some of the top points. I thought, obviously, like I said, you really want to take your market into consideration when you're reading this, and does it kind of align with what this is saying? And because each market's different, but I think it's really good to be informed from a national perspective where things are going. Obviously, this could change in snap of fingers. But overall, I don't see anything but positives for multifamily. Obviously, prices are crazy. Supply chain issues, are affecting, if you're doing a value add renovation or developing. But overall, there's still so much demand. And with wage growth, I think it'll support rent growth on top of just the demand itself for people needing to live somewhere, that they will, allocate more of their income to living just to lock down a spot. All right. Well, thank you all for tuning in. I hope this wasn't too boring. For those of you that like numbers and finance, you might have liked a little bit, but hope there was some value in here for you all. Again, please reach out if you ever have any questions. Best place to find me is at Shawn Owens on Instagram or Shawn Winslow on LinkedIn. I will catch you all on the next one, and have a great week.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.